Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today we have some real numbers here. We're going to go ahead and get rid of all these debts. It's not going to take us like the bank wants us to be on. We're not going by the bank's plan. We're going by the Velocity plan. We're also going to be mentioning something that may sound familiar to you, but we want to show you how to collaborate with these different budgeting financial systems that are out there, debt snowball, debt avalanche, whatever it is. We want to show you how Velocity Banking can actually add efficiency and more effectiveness to what you're already doing. So before we go ahead and pay this off, I want to let you know, please like, share, and subscribe so that everyone around the world can know the power of Velocity Banking. Listen to this. We're not going by our $10,000 limit anymore, okay? Because this is a real scenario where someone said, CJ, I don't have the $10,000 in limits. I just have the $900 in credit limits. Can Velocity Banking still help with that? And not only that, but they only have a cash flow of $150. But as we say in Velocity Banking, $150 is better than $0. Can you still do Velocity Banking with $0? Yes. Can you still do Velocity Banking with negative cash flow? Yes, right? But just not as effective, not as fast, okay? So you having that $150, Jay, is stupendous. We're gonna show you what to do with that $150, okay? So as is our custom, let's go ahead and go over what we have here. Then we're gonna dive in and show you how to pay all of this off, okay? We have $28,004 at 20%, $403 each and every month. Then we have another lender, $11,434 at 12%. That one's at $150 each month. And then we have the next loan, $12,636 at 15%, $150 each month. Then the last one is $20,598 at 7%, and that one's actually going to be at $280 each and every month. Now you may be looking at this and wondering what in the world these numbers are. Maybe some of you know, some of you don't. I'm going to explain as we get through the video, okay? Then we have the credit limit of $900, and really the interest rate doesn't matter. Do you know why? Because we still want to use our line of credit as our deployment tool, okay? It is a deployment tool, meaning we're not just gonna let this $900 sit there. We are going to deploy this $900 towards one of the principals on these loans, okay? Now, I know a lot of you may be already familiar with the debt avalanche method, where you're going to be paying the highest interest rate first. Remember, Velocity Banking does not run competition with any financial way of doing things out there. So we don't run competition with debt snowball. We don't run competition with debt avalanche. You can actually mix these two, right? The debt snowball and Velocity Banking. You can mix those two together and you come out with a debt blizzard, right? You can mix the debt avalanche method and Velocity Banking, and you come up with a brand new concept called the debt blizzard. Now, let's go ahead and pay these off. But before we do, right, I'm going to show you how to pay them off with the line of credit. Before we do, I want to explain to you what these numbers are here on the side. So these numbers here indicate the cash flow indicator method, meaning when you're using Velocity Banking, we want to make sure we get rid of the cash flow sucking, the most cash flow sucking loan first, right? Which is usually the auto loan. And oh, by the way, it is, right? So the auto loan for $28,004, we got to go ahead and get rid of that one first. It is at a 70 cash flow indicator. If you don't know what the formula is for that cash flow indicator, it is the loan balance divided by the minimum monthly payment. So this number divided by this number. That's how you get that indicator. That's how you get the one that is cash flow sucking loan, Okay, now how do I do that, right? How can I say that this is the most cash flow sucking loan? How do I know that? Well, in relative, right, relative to what you're getting, okay, it's cash flow sucking. So we do have to add that caveat there, because notice this right here, 12,636, right? And you have the $150 each month. You're getting more here, okay? You're getting more here, and you're only paying the $150 versus you getting less, right? And paying the $150, all right? So we want to make sure we're going by that. And that cash flow indicator method was actually created by a rocket scientist. Can you believe that? Shout out to Dale Clark. So here we don't know which loan to pay off first, but now we do, okay? Which one is lower in number? Because the one that's lower in number is the inefficient loan. Which one? This one. So we're going to go ahead and start off with this one. And look at how much cash flow we would have to pay off the rest of the loans when we get rid of this one. Isn't that beautiful? So let's go ahead and get rid of this loan right here, and then we're going to see how much cash flow we can have afterwards, okay? So let's go ahead and do that now. So if for the amount of time you're in this loan, right, you stay there for 7 years, right, you would have paid off all of this amount in 7 years by using the velocity banking method, meaning you deploy the $900 towards this principal, and you're using the cash flow of $150 each month to pay that $900 back. Now that's going to take you about 6 months. When 6 months is expired, you then deploy it, because remember, it's the R&D method. You're replenishing and deploying, okay? So let's make sure that we know what that is. Okay, R&D doesn't stand for research and development. It stands for replenishing the line of credit and then deploying it towards the principal balance. Now, that's just saying that you plan on staying at the $900 limit the whole 7 years. That's just saying that you plan on staying at the $150 mark the whole 7 years. Okay? The whole 7 years. Yes, you'll pay that off at the end of the 7 years. And yes, you'll pay all of this off at the end of 8 years and 2 months. But that's if you stay here. Remember, when you pay this off in the 7th year, right? But I don't think it's going to take you the 7 years, because I think you plan, Jay, increasing this. You plan on increasing this, and you plan on increasing this. I don't think you're going to hold yourself short like that, okay? So maybe in 1 or 2 years, you can get that up to at least 10,000. You can get this up to 2,000. And then, of course, you already know where I'm going with this, all right? Now, if you're going by the bank's method, okay, or going by the simple debt avalanche method, you're going to be in this for 10 years, all of it. Okay, 131 months is what you plan on. But let's go ahead and combine the methods so that you can be out of it in less time. Because when you're out of this loan, where does this number go? The $403. It goes to your cash flow, right? So now the more cash flow you have, the greater you can pay down that debt, so that instead of being out of the line of credit in 6 months, now you're out of it in 2 months, right? And then as you continue, right, to pay off these loans, now you're out of it even quicker, right? Now, if you don't have any debt, that's a bad thing. Remember, we're in a debt-based economy. We need to make sure that we're getting our loans and our lines towards assets now. So you do still need a loan. Now that you know how to pay it off, let's go ahead and do that. Does that make sense? Listen, don't sell yourself short. You don't want to be here the whole 7 years, all right? You don't want to be here the whole 7 years. Now, if you plan on doing that, go ahead and do it, all right? Like I said, we'll get you out of here in 8 years. Now, those who already have the money max, they're like, CJ, there's a way quicker way to do that. I know, but listen, I gotta be honest with you, I can't beat a computer, okay? I can't beat the software, right? They got millions of lines of code, man. How are you going to compete with that? All right. So of course the Money Max is there. If you need more information on that, we have a webinar every Tuesday that you can get a hold of. But that's how you do it. Okay, Jay? Make sure that you're utilizing the lines of credit and whatever you have to go towards the principal of any loan and any cash flow, right, that comes your way. Make sure you're using that to pay down those lines of credit to get out of that emergency so that we can get you into assets instead. All right. So listen, the cash flow indicator, that's what you're going by, because we need to free up this cash flow. If you have any questions, don't hesitate, contact us, and we will see you this Tuesday on the webinar. God bless you.